Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about New Oriental S annual report. New Oriental Education and Technology Group Inc. provides a wide range of educational services and products to students in China. The company operates four main segments: educational services and test preparation courses, online education, and other services, overseas study consulting services, educational materials and distribution. The company offers various services, including test preparation courses for language and entrance exams, non-academic tutoring courses, intelligent learning systems and devices, overseas studies consulting services, online education through the Koolearn.com platform, development and editing of educational materials, sales of educational products and programs through schools, learning centers, bookstores, and online platforms. The New Oriental S stock price has dropped by over 25% in the past year due to a significant news event in January 2025. The company's weak revenue guidance triggered this decline, with projected revenues falling short of market expectations. Specifically, New Oriental projected its total net revenues to be between $1 billion and $1.03 billion for the 3 months ending February, which was significantly lower than the expected $1.32 billion. This announcement led to a sharp decline in stock price, resulting in a 26% drop on January 22, 2025. The primary drivers of revenue growth or decline in the education sector company can be summarized as follows. Revenue growth is primarily driven by three key factors. 1. Educational services and test preparation courses. 2. Overseas study consulting services. 3. Live streaming e-commerce revenue, although it declined in 2025. On the other hand, revenue decline is attributed to 1. Impairment of goodwill in the kindergarten business reporting unit. 2. Increasing amortization expenses for intangible assets. Net income and profit margins. A changing landscape. The financial performance of a company has undergone significant changes in recent years. Net income, which was $235,363 in 2023, experienced a substantial increase to $325,218 in 2024, 39% growth, and further rose to $375,833 in 2025, 16% growth from the previous year. However, this growth in net income did not translate into improved profit margins. In fact, operating margin declined from 6.3% in 2023 to 9.8% in 2025, while net income margin decreased from 7.8% to 7.6%. This indicates a decline in profitability despite the increase in net income. The segment profit margins also reveal a mixed picture, with some segments experiencing significant growth and others facing losses. The company's revenue growth is notable, with a 43.1% increase in 2025 compared to 2024. However, this growth may be influenced by contractual arrangements with variable interest entities, which could impact profit margins. Additionally, the effective income tax rate may be affected by potential underpaid taxes or computational errors. Overall, while net income has increased, the decline in profit margins suggests that the company's financial performance is becoming less efficient. The company is indeed generating positive operating cash flow. According to the financial summary, in 2023, the company generated $965,336 in positive operating cash flow, increasing to $1,310,909 in 2024 and $1,041,249 in 2025. This consistent trend indicates a stable and improving financial performance for the company. But the company's debt level and interest expenses have undergone fluctuations over the years. While there is no clear indication of a significant increase or decrease in debt level, overall, specific pages reveal some changes. Total liabilities decreased by $2,891,735 from 2021 to 2022, but increased by $369,108, 10.6%, from May 31, 2024 to May 31, 2025. Interest expenses have changed significantly in some years. For instance, interest expense decreased by 58% from $707,000, 2023, to $298,000, 2024, but then increased significantly from $311 to $31,135. However, there are also instances where interest expenses showed no significant change. Management is optimistic about the company's outlook, citing significant growth in net revenues, net income, and total assets over the past 3 years. The company's strategy focuses on expanding operations through contractual arrangements with variable interest entities, VIEs, which accounted for a substantial portion of consolidated total assets in 2024 and 2025. Management views this expansion as key to driving future growth and increasing shareholder value. Acquisitions and divestitures overview. East Buy has made several strategic acquisitions and divestitures over the past year. Key acquisitions include the purchase of time with Yuhui by Mr. Yuhui Dong in July 2024, as well as the transfer of Beijing Kuksu Huisi Network Technology Co., Limited, and Xian Ruiying to New Oriental China. Additionally, Metropolis was acquired by a company wholly owned by Mr. Yu. On the divestiture side, Time with Yuhui ceased to be a consolidated affiliated entity in August 2024, while Wuhan Dongfeng deregistered. These transactions reflect East Buy's efforts to optimize its portfolio and focus on core business operations. The company has a history of paying dividends, with a notable instance being a special cash dividend of $0 and 60 cents per ADS or $0 and 6 cents per common share in August 2024. However, there is limited information on whether the company has engaged in share buybacks, with only a mention of share repurchases as one option in its 3-year shareholder return plan. Concerns about inventory buildup or supply chain disruption have been raised in East Buy's financial summary. Specifically, there is a risk of counterfeit products being sold by suppliers or third-party merchants, which could lead to liability claims against the company. Additionally, data shows that the cost of revenues as a percentage of total net revenues has decreased over the past few years, indicating potential inventory buildup or supply chain disruption concerns. These issues are not related to traditional transportation problems, but rather to product authenticity and liability. That concludes the financial summary. For New Oriental S, feel free to comment below, and I will be happy to answer them when possible.